All right, let's get started. Today we're doing a deep dive on Comfort Systems USA, ticker FIX. And to be clear, our focus is 100% on the operating business itself.
So why are we all here talking about this company? Well, it really comes down to one number. Since the start of 2020, the total return on this thing has been a staggering 1,888%.
The real question is, how on earth did that happen? And maybe more importantly, what does it tell us about the future? Our job today isn't to get mesmerized by that number. We need to get under the hood, we need to dissect the business machine that produced it, and really understand how durable it is and what risks are hiding in plain sight. Okay, so first things first. We need to wrap our heads around just how much of an anomaly this performance has been.
And what's really striking when you look at this is the sheer consistency. I mean, take a year like 2022. The S&P gets hammered, down 19%, and FIX is up 17%. This tells you it's not just a story about riding a bull market. We're seeing a pattern of major outperformance in both up and down markets. And then, in the last few years, it just hits the accelerator. It's breathtaking.
In this chart right here, this shows you it's not just market sentiment. The performance we just saw is bolted onto some incredibly powerful business fundamentals. A 29% three-year average revenue growth, that absolutely dwarfs the broader market's 5.5%. This is the engine. This is what's driving those returns.
But here's where the alarm bells usually start to go off, right? That kind of rocket ship growth often means a company is taking on a ton of leverage. So the next critical question is, what's the quality of the balance sheet here? Is this growth built on solid rock, or is it a house of cards?
While the numbers here are stark, a debt-to-equity ratio of 0.01 is, for all practical purposes, that's zero debt. At the same time, the company is sitting on more than double the cash relative to its assets compared to its peers. This isn't just a strong balance sheet, it's a fortress.
And that is the crucial point. This is not growth funded by leverage. It's organic. It's self-financed. That financial stability gives them a massive buffer against any downturns and, maybe more importantly, it gives them immense optionality for the future. So, the story so far is pretty compelling. You have an outperforming business with a pristine balance sheet. But, and this is a big but, every asset has a price. And that brings us right to the central tension of this whole analysis. Look at what the market is paying for this company. Across every single key metric, it's being priced at a massive premium. A price-to-earnings ratio over 40 when the sector average is just 17. A price-to-sales of 4.1 versus 1.7. And the big one, price-to-free cash flow, over 42 compared to the sector's 13.5. The market is valuing this business at more than double and in some cases triple the price of its peers. This is really the core of the due diligence question in front of us today. Is that premium justified? Is there some fundamental shift in the business that warrants that price? Or is it a sign of dangerous optimism from a market that's just extrapolating the recent past forever?
To justify that kind of valuation, you have to believe there's a powerful, long-term tailwind that isn't fully captured in the historical data. And the main hypothesis on the table is the AI data center buildout.
So a potential explanation for this valuation starts to emerge from this huge macro trend. You see a note like this from Bank of America, and they're explicitly linking the AI boom to skyrocketing electricity demand. Well, data centers are incredibly power-hungry, and all that power generates an immense amount of heat that has to be managed. This is exactly where Comfort Systems, a specialist in industrial-scale mechanical, electrical, and plumbing, steps into the picture. And the scale of this build-out is just significant. We're seeing massive capital commitments from every single major tech player. But the key to FIX's position is their operational model, this strategy of off-site modular construction. See, they build these incredibly complex HVAC and power units in a controlled factory environment, not on some chaotic construction site. This does a few things. It increases their margins, it improves quality control, and critically, it helps them mitigate the industry-wide shortage of skilled labor. This operational advantage may be their true secret sauce in capturing a disproportionate share of this demand. And when you hear about projects on the scale of a rumored $100 billion Stargate initiative, you start to think this might be a decade-long infrastructure cycle.
So this brings us to our final and most critical questions. Is the market correct to price Comfort Systems not as a traditional industrial company, but as a key enabler of this generational build-out? And if it is, how are they managing the immense execution risk that comes with it? As these projects scale up to the gigawatt level, a single mismanaged contract could wipe out an entire year's worth of profit. And what about the skilled labor shortage?
Is their modular approach really enough to overcome that hard cap on the industry? Or will that ultimately limit their growth no matter how high the demand is? That is the core risk we have to underwrite alongside this opportunity.